What is next for gold in the second half of 2020? Guys, welcome again to Forex Trading Strategies. Hit the like button to get this video in front of many other Forex traders. If you are looking for Forex Trading Strategies, you have come to the right place. Subscribe if you are not yet subscribed in order to be notified of future videos when we upload. Go through the channel for awesome Forex trading strategies. Also visit the blog, the link is in the description, to download leaked VIP group Forex systems, indicators and strategies. Before we get into today's video, some legal stuff. Please note that I am not a financial advisor and that all the content posted on this channel does not constitute financial advice. If you need the services of a financial advisor, I recommend you look for a person like that in your town. In simple English, all the information posted on this channel is my own opinion. Use the information posted on this channel at your own risk. Now that we have that out of the way, let's talk about the topic of today. If you are like me, you have probably also made money and some losses on gold. If you are better than me, then you probably made a lot of money on the gold bull run. But now everyone is wondering where to next for gold. It only took 8 years for gold prices to set a fresh all-time high, breaking out this week to extend the precious metals bullish advance that started in the second half of 2018. And, perhaps more accurately, gold didn't just set a fresh all-time high, it surged right to it, soundly taking out the prior high watermark of 1920 on Monday and continuing to rally through Tuesday to a fresh high at 1,981.20. Earlier in July, the price of gold passed $1,800 for the first time since 2011, prompting excitement among investors. The marked culmination of a lengthy and sustained rise from $1,500 that began earlier this year as central banks around the world ballooned their balance sheets. The steady pace of this appreciation suggests it is a structural shift in the makeup of the market rather than a fleeting bubble. What's been going on? Gold ETFs close H1 with record $39.5 billion net inflows. Despite supply disruptions, gold has experienced huge inflows since the start of the year, most notably in exchange-traded funds, ETFs. According to gold.org, in June total holdings leapt from $30.57 billion to an all-time high of $39.5 billion. Gold is often seen as a safe haven asset, but in truth it has performed well in both good and bad times. However, the present environment of super low interest rates around the world has significantly reduced the opportunity cost of holding bullion. On occasion, there have been trading sessions where traders sold gold for cash to cover losses elsewhere in their portfolios, especially during the heavy sell-off in March. This drove the price down, as seen concurrently in equities and other risky assets. However, this fall was quickly corrected when a combination of the highly uncertain conditions created by the coronavirus pandemic and the massive stimulus packages embarked on by governments and central banks drove demand back to precious metals. The net result of all this drama was to drive gold into uncharted territory against not only the US dollar, but other major currencies such as the euro. If we look at the period immediately following the 2008 financial crisis, the US public debt to GDP ratio more than doubled, triggering a bull run in the gold market. Something similar happened after the dot-com crash in 2000 and after the Wall Street crash in 1929. There is every reason that, with the US deficit set to quadruple, history could repeat itself. The government would then be faced with hard decisions over whether to raise taxes or cut spending, either of which would have an uncertain impact on growth. The inflation danger. Inflation is another key factor to watch for, given its impact on real interest rates. When inflation increases, real interest rates, nominal rates adjusted for inflation, tend to fall, discouraging foreign investment in a given domestic economy and boosting gold prices. In the current situation, there is good reason to think that the market may be correct in its attraction to gold, as the current expansionary monetary policies in key nations are effectively financing fiscal spending. This is in contrast to the key programs of the past decade, which essentially propped up bank reserves. If inflation does pick up, the G3 central banks, the Fed, ECB and BOJ, are unlikely to instantly reverse course, as their priority at this point is resuscitating demand in a post-COVID world. That, in turn, will drive real interest rates lower, making gold even more attractive as an investment. Additionally, the rise in gold prices could also bring turbulence to the stock market. Low-level inflation, however, can be toxic for stocks, especially in an economy with little pricing power, as it erodes corporate profit margins, but gold is on hand to, as ever, act as a counter-inflationary hedge. How far can gold go? $3,000 an ounce? What can we expect later in the year? Analysts at Bank of America, for one, are optimistic on the outlook for the yellow metal, raising their 18-month price target to $3,000 an ounce, more than half as much again as the 9-year-old record of around $1,921. Why such confidence? With the increase in demand for gold mutual funds and the prospect of seemingly endless monetary expansion from central banks, they see a bullish future for gold, as demand is only likely to continue during the crisis. As the saying goes, the Fed can't print gold. CME responds to gold market logistical developments. Another reason to think gold's bullish run is likely to continue is the new gold futures contract launched recently by CME Group. Gold prices could still hit $3,500 in 2 years, one analyst says. The gold market is very strong and could hit $3,500 in 2 years, one analyst told CNBC this week. This is after prices surged and reached record highs on Monday amid worries over the coronavirus pandemic and tensions between the US and China. What is really significant is how quickly it went through that $1,923, which was the previous high. The other thing which was very important was the fact that it went through $1,800 and with similar ease, said Barry Dawes, executive chairman at Martin Place Securities. That's basically saying to me that this is a very strong market. Spot gold traded about 0.55% lower at about $1,931.24 per ounce on Tuesday afternoon in Asia. I'm looking for $3,500 within 2 years, Dawes told CNBC's Street Signs Asia. He said some consolidation is probable, but the underlying strength of the rally is very significant. Garth Bregman of BNP Paribas Wealth Management predicted that prices could consolidate around $2,000 before increasing again. We don't see any catalyst in the short term for gold to stop its rise. In fact, the factors that have driven gold to these new highs are still very much in place, said Bregman, who is the Asia-Pacific head of investment services. Georg Kiener, managing director of Swiss Asia Capital, is also bullish on the precious metal. If you look at the technical picture, you could actually take this gap from the bottom up and going to the top, that gives you about $2,834, and that would be an initial target, probably that you could achieve quite fast, he said. I think my longer-term targets are significantly higher, he told Capital Connection. Historically, he pointed out that gold prices have moved 7 or 8 times higher from their bottoms. If your bottom structure was $1,050 times 7, that will give you about $8,000, he said. Why gold is attractive? Kiener said gold is offering significantly higher returns in the next 12 months compared to the low returns on US Treasuries. Basically, you have no more yield curve. The yield curve has been flattened to the extreme, he said, noting that real yield returns are moving into negative territory in many countries. The yield on the benchmark 10-year Treasury note is currently at around 0.61%. Gold, as a result, starts looking very attractive indeed, and that will continue to not just basically attract people who are looking at tail risk hedging, but as well, people who are looking at yield creation. David Gaud, Asia Chief Investment Officer at Pictet Wealth Management, agreed that gold is still worth holding. The key reason is the low interest rates, and interest rates are set to remain low not just for the shorter term, but for the mid to long term, he said. The whole case for holding gold continues to make sense, he said. Dawes of Martin Place Securities said a lot of gold has been absorbed by Asia and the Middle East, which has left the West at the margin, underweight. The West has to rebuild its position, and the only way they're going to do that is really by pushing the price higher, he said. He added that there are many issues that drive price moves in the precious metal, including currencies and coronavirus stimulus packages. At the end of the day, it's just going to be a very tight market, and particularly with the central banks having bought more gold over the past few years. So what must you do as a trader? It is important to remember that any kind of trading is risky, and there is never a solid guarantee of profits. So as traders, implement risk management tools in order to control your capital and manage losses. Where do you think gold is going in the near future? Leave a comment in the description box below. If you have questions, also leave them in the comments box below, and we will try our best to answer them in the coming videos. Again, remember to subscribe if you are not already subscribed, and once again hit that like button.